Welcome to the debate. It is February 27, 2026. Today, we are looking at Salesforce, ticker CRM. It's a $182 billion behemoth trading right around 195.
Right. And the central question here isn't just about their recent earnings. It's really about identity. Is Salesforce a maturing utility company that should be priced like a low-growth bond, or is this aggressive pivot to Agentforce creating a genuine second growth curve?
Exactly. And I'm arguing that this is a high-moat AI platform that is currently mispriced by the market.
And I'm arguing that the growth story is over. This is a company facing structural saturation, relying on financial engineering to hit numbers, and frankly trading at a premium that just doesn't match its slowed reality.
Okay, well, let's get right into the numbers. Salesforce is the undeniable system of record for the enterprise. They have a 21% market share, but here's the misconception. People think it's stagnant. In FY26, revenue grew 10% to $41.5 billion.
Which is a massive step down.
Sure, but that isn't the exciting part. The excitement is the pivot to Agentforce. These aren't just your standard chatbots. These are autonomous AI agents executing work within the CRM. Along with Data 360, this segment's annual recurring revenue, or ARR, is up over 200% to $2.9 billion. They are proving they can retrain a massive sales organization to sell consumption-based AI, not just seat licenses.
But 10% total growth is a huge drop from the 20+% days of the past. You are asking investors to pay a PE multiple of 25 to 26 times earnings for what is essentially a utility stock. That is a very rich premium. Furthermore, that valuation relies heavily on non-GAAP metrics that conveniently strip out the massive cost of stock-based compensation. To me, it looks like a company struggling to find organic growth, using the balance sheet to prop up the stock price.
I think you're looking at the aggregate and missing the velocity under the surface. In Q4, subscription revenue growth accelerated to 13%. That is the signal. Specifically, Agentforce ARR hit $800 million, up 169% year over year.
Yeah, but 169% growth is easy when you start from zero.
It's not zero, it's 800 million. When you have triple-digit adoption in your newest product, that suggests they are embedding themselves deeper into customer workflows. That justifies a tech multiple, not a utility multiple.
800 million is a rounding error against a 41.5 billion revenue base. It's not moving the ship. Meanwhile, the core CRM market is an absolute knife fight. You have Microsoft Dynamics, ServiceNow, and a legion of AI-native startups eating away at the edges. If those competitors start eroding pricing power, that 13% subscription growth will evaporate and you'll be left holding an expensive bag.
I have to disagree because you are ignoring the fortress they've built. This is a cash machine. FY26 operating cash flow hit $15 billion. That's up 15%. Their non-GAAP margins are expanding to 34%. They have the capital to defend their moat against Microsoft while funding this AI transition.
You really have to put an asterisk on that cash machine. The GAAP operating margin, the real number, is only around 20%.
Which is still healthy.
But the difference between that and the 34% figure you cited is mostly stock-based compensation. So sure, they returned $14.3 billion to shareholders via buybacks, but a huge chunk of that was just offsetting the dilution from paying employees in stock. It's capital recycling, it's not value creation.
It's not recycling if the revenue's locked in. Look at the RPO, the remaining performance obligation. It stands at $72.4 billion. That is nearly 2 years of future revenue contractually guaranteed. When you combine that visibility with high switching costs, the floor is much higher than you think.
High switching cost won't save them from bad execution. They are currently digesting the massive Informatica acquisition to try and fix their data layer. Large-scale M&A like that is a classic distraction that slows down innovation. They are buying a legacy data company while trying to pivot to AI, all while spending $50 billion on buybacks at what I consider an inflated valuation. That is a lot of risk stacked on top of a quote-unquote safe play.
Well, I see it differently. I view Salesforce as the only genuinely safe AI play in the market. It's a profitable fortress with a clear path to $63 billion in revenue by FY30, driven by the inevitable adoption of Agentforce.
And I conclude that without a sustained double-digit re-acceleration across the whole board, the stock is dead money. The math just doesn't work at these multiples compared to faster-growing peers.
A tension between a proven legacy moat and an unproven AI future. That is where we leave it today. Thanks for joining the debate.